I wanted to start out with some U.S. consumer data. I believe you're quite positive on U.S. consumer credit at the moment, and you're expressing that through residential mortgage-backed securities as well as CMBS. What makes you comfortable with those positions when a lot of people have been talking about the end of the U.S. economic cycle?
Well, look, I mean, if you think about what the consumer's done since the crisis period, right, the consumer has cleaned up their balance sheet, rather remarkable. You know, debt to GDP has gone from about 100% to roughly 75. Debt to income's gone from about 1.3, 1.35 to about 0.98 now. The savings rate's been in a very healthy 7.5 to 8.5% level. And financial obligation ratios, whether you look at debt service, mortgage debt service, or total financial obligation ratios, are at 39-plus-year data series lows. So we're in a very fortunate position now in the U.S. labor market that the U.S. labor market is still relatively healthy despite all the angst that we've seen the past 2 years. That's creating enough wage gains and wage inflation to allow the consumer to spend at a healthy enough rate to support the U.S. economy, while simultaneously allowing them to continue to delever and run a healthy savings rate. That's a very unusual situation to be in. And so we can't look out 3, 4, 5 years, but what we think is at least in the next year, before that data starts to deteriorate, it has to at least stop improving. So that's really why we have so much confidence in that investment thesis now.
Troy, a very good morning to you. Good luck with the next couple of days in Abu Dhabi. Let's dig a little bit deeper into some of your calls.
Thank you so much.
You've got here, we have a mini equity bubble, and I reflect back to Dennis Gottman's letter late last week where he talks about egregious valuations in the equity markets. So are we in bubble territory, or what is it that could prick that particular move on the equity side?
Yeah, look, so we don't think we're in a bubble now. Obviously, equity valuations are elevated. They're at the top end of the post-crisis range. The only time they've been higher is late 17, first 3 weeks of January of 18, when there was so much euphoria around deregulation and tax reform. So just to be clear, we don't think we're in a bubble now, but you can see, due to the Fed cutting 3 times and now pumping up their balance sheet rather massively. You know, they've already injected about $300 billion of capital. About $270 billion of that is leaked out from excess reserves. They're going to probably ramp it up another $450 billion. So that combination, plus economic data that continues to be better than, let's say, the consensus forecast as recently as 3 to 4 months ago, you can see the path for at least a mini equity bubble forming next year, which is one of our non-consensus calls. We're not saying that it's a 100% probable outcome, but that outcome's much higher now than it was as recently as even 3 months ago.
Troy, since we're talking about equities, one of the big debates that we've seen amongst stock investors is, of course, value versus momentum. JP Morgan's Marko Kolanovic is out with his 2020 outlook today, saying that we're basically at the beginning of a rotation into value. We've only seen the start of it. What's your take on momentum versus value at this period in time, and where are you actually positioned?
Yeah, so that's a real tough trade to jump in front of. I mean, when momentum and value diverge, as they have for the past several years, it classically reminds us of the late 90s, right, where many people got run over trying to jump in front of that. That being said, again, if you pattern this equity market cycle after the late 90s, what started to happen to deflate the outsized performance of momentum versus value was, you know, equities started to cool off. Obviously, the economy started to slow. And then you finally saw real convergence in 2000 and early 01 in particular. So we think it's still a little bit early for that, you know, given our thoughts on what the Fed's balance sheet expansion is doing to markets in the short term. But no doubt about it, if and when the economy slows much more meaningfully than it has so far, and some of these forward multiples start to come in, that's when you'll see value really start to shine versus momentum, which has clearly not been the case the past several years.
It's interesting that you say in your notes that the situation, you talk about the Fed and that expansion of the balance sheet, call it whatever you wish, but it is an expansion. Who would have dreamed that a stealthy QE even 5 months ago? What are going to be the consequences of that QE by stealth?
Yeah, so that's the thing, and I'm sorry I didn't get back to what can end up pricking that before in the question. But so remember the issue. The whole reason the Fed was tightening monetary policy in 17 and 18 was to tighten financial conditions, so we didn't have runaway inflation or any asset bubbles forming. You know, people forget, but the last two crises in the U.S. and downturns were caused by imploding asset bubbles. First, you had the equity bubble in the 90s, and then the housing bubble, really from 05 through the middle of 06. And so the consequences of what the Fed are doing now is you could end up in that mini bubble, which sets the stage for a more pronounced downturn in 2021. Furthermore, you know, the debate still rages. How much hotter can you run the U.S. economy with unemployment this low without having meaningful wage inflation, right? Because if there's one thing we know right now, almost no active market participant is pointing to or pricing in any probability of inflation coming back, and we know that you can't get true inflation without wage inflation. So what you could see again next year is a mini equity bubble forming, perhaps commercial real estate prices getting a little too hot. You know, Donald Trump wins re-election. Then we're at a point where the Fed has to respond because wage growth's gone from 3.1, 3.5 to 4, 4.5, given the tightness of the labor market. And then that will get us right back to where we were in late 2018, where the Fed has to respond. They have to tighten more abruptly. And then we have a big downturn sometime Q1, Q2 of 2021. Now, you certainly can't take risk based on that type of forecast now, but what you can do in the short term is understand that any divergence of the fundamental growth story, even if tariffs were to be implemented, we don't think would lead to nearly as big of a downturn of markets as it would have in 17 or 18, because you have this backstop of liquidity just flowing from the Fed.
Right. Now, Troy, one of the reasons we have that backstop of liquidity is because of the repo market mayhem that we saw in September. We also had the Bank for International Settlements coming out over the weekend and talking about how some of that mayhem might have been caused by hedge funds who are financing more bond positions through repo. What's your take on that? Is that something that you do over at SkyBridge? And what's your outlook for the end of the year as we get to it, whether or not we're going to see another replay of that money market madness?
Yeah, so it's a great question. So, you know, first of all, we've been very supportive of Fed policy. You know, clearly they arguably made a mistake with the December hike, but they pivoted rather remarkably. But what we can't figure out for the life of us is why, you know, their calculation for excess reserves was so much higher than what the banking system had to actually hold to meet a lot of the regulatory requirements that have come out of the crisis. And in fact, if you just go to the Fed website and you see that basically only $200 billion are considered non-excess reserves, when Jamie Dimon said they have to hold at least 260 to 280 billion. So you just do simple math, and you know, if JP Morgan has to have 260, maybe B of A is 240, you know, someone like Morgan Stanley 180, Wells Fargo 200, the numbers start to approach that excess reserve level really fast. So we would lay that problem, unfortunately, directly on the Fed. Now, that being said, there is some credence to the fact that hedge funds and the banking system in general have been much more reliant upon repo. And the reason for that is again, tied to regulation. So banks have tremendous capital charges now to hold any investment as equity or an at-risk investment. And it's really made it uneconomic for them to participate in any type of prop trading, as you know, or any type of direct security risk. So instead, what they've done is they've expanded their lending operations rather dramatically, and they've increased they've improved terms for hedge funds. So if you're a hedge fund manager, you're sitting there saying, hey, if a JP Morgan of the world or Morgan Stanley doesn't want to take that risk, but they're happy to take it if I'm the equity part of the capital structure and lend against me at very good terms, then that's something I'm going to do to help improve returns for investors. So, you know, there isn't one real factor to blame. We would primarily point to the Fed, unfortunately, but certainly hedge fund utilization of repo has grown dramatically since the crisis. Now, in terms of do we expect a repeat, you know, there probably will be some stresses that emerge. There always are year-end, even when we haven't had an episode like we had recently. But that being said, given the amount of liquidity that's been flooded into markets, we think it won't be nearly as pernicious as what we saw, you know, back in September.